Hello and welcome to Joe and Paul's Another Mining podcast. From here in Beaver Creek in Colorado, we are at the Precious Metals Summit, arguably one of the most important junior mining events of the year, particularly for the precious metal space. Hi Joe, how are you?
Hey, Paul. Congratulations.
It's good to see you again. The last time we saw each other was at PDAC a year and a half ago, where we weren't sure which bits of our body we
don't
needed
have
to
masks on.
bash together to say hello.
Well, it's interesting. The Precious Metals Summit, more people I talk to at meetings tell me that the last time they've been outside of Canada, basically, was PDAC. And so a lot of these CEOs haven't traveled.
I think I've met a couple of people who the last time they were physically outside was probably a year ago. They've been in a box or something for a while.
Yeah, we've had a good crowd. I mean, given that, like right before we got here, I was getting cancellations on the virtual meetings, which I wasn't taking because there were a lot of people from like Toronto and banks and brokerage firms that just said that they weren't going to send anybody. But in the end, I think we've got a decent crowd.
Yeah, there's obviously noticeably fewer people than in past years, but there are benefits to that. You can actually get to the cappuccino machine and get a decent coffee in the morning.
I don't think we had a cappuccino machine last time.
Oh, it's always been downstairs.
Yeah.
You can't see it because of the crowd and the crush.
Yes. Yeah. Okay.
But the people here that I've had some, 2 days in now, had some really good meetings, learning a lot as always, which is obviously the key point of being here. I'm sure the same for you. I've been sort of catching up on stories, I've been following and getting updates, and also a little bit of being exposed to sort of news stories, but just picking up on the overall feeling and gossip of how people feel the sector is going at the moment.
Yeah, well, I would say the benefit, ignoring COVID in terms of the risk, the benefit of these conferences is getting all that information about something you're learning about or want to learn about from 5 different sources who have different motivations, different biases, and then hopefully you can come to some kind of conclusion or collective knowledge about what's going on. Such as like that article you did about the Silicon area. I've met with Corvus. I know what's happening there. I met
that was
my
interesting.
friend,
I met with Jeff as well, and
and I met my friend who was the VPX for Anglo, but he wouldn't say anything. On Coeur, he was talking about what they're doing, drilling at the Seahorse, and then when they're going to come out with the resource, and also mentioned how many rigs Anglo had, and that they were drilling 3,000 foot holes and going really deep. So all that information comes in, and then you go, okay, that's good, and they don't have any bias one way or the other to tell you or not, because they're not hiding any of their knowledge.
But it's additional layers that help build out a picture,
and you wouldn't get that in a Zoom call.
Yeah.
And so that's one of the huge benefits of this sort of conference.
One of the interesting things is, gold is about $1,800 an ounce, still at very historically high levels. It's been there, give or take, for more than a year now. For producers, it's great times. They're making money hand over fist, most of them, putting the money away. But it does seem to be a different story for non-producing junior explorers. Gold price is riding high, but share prices have come off 30-40% since this time a year ago. So you've got a dichotomy there, a healthy gold price, but stock prices are suffering for juniors.
And if we go back into this, and I've talked to this with my subscribers, is that most evaluations and all that are dependent on what they think about the future for gold price, and that's where I would say the producers are being impacted, because people are saying, okay, the interest rates are going up, that can only be bad for gold, and my biggest exposure is in gold, it's gold equities, and that's how I play it. I'm going to be selling or reducing my position. But for the junior explorers, it's a bit of a different story, because like we know that the producers, the big ones have book reserves at $1,200, $1,250, their balance sheets are great, they're generating cash flow, free cash flow, and they're looking very good in an environment that could come all the way back down to 1,400.
Yeah.
Not that anybody's asking for it to go, but they're pretty happy with where it's at right now. And then the question is, but they have no pipelines. And so the interview we did with Rob Kirchmeroff of Barrick was that, hey, you've got a flat production profile. Is that the new growth, or and then you say, where are the projects going to come from? And then it's not isolated to Barrick. It's Newmont. It's anybody. But then you look at the mid tiers, and they're the ones that want to show growth, so they're very acquisitive. But I think COVID's pulled a little bit of that back. But if you look at Equinox's presentation, it's step functions to go from where they started at 150 to 200,000 to where they want to get to, which is $1 million, and most of it's acquisition.
Yeah.
So there's no way I don't think that some of these assets that are really good won't get taken out. It's just a matter of timing.
But let's go into sort of valuation a little bit. And it always brings me back to, I've watched Shark Tank, and the guys on Shark Tank always say your valuation is what you're worth today, not what you may be worth tomorrow, no matter how good your projections are. And that seems to be something that escapes a lot of junior CEOs, because they're always trying to put their valuation on what they may be in a year's time or 2 years' time, when the market's telling you today your valuation is.
The thing is that if you know about a discounted cash flow, the models, the NAVs, and it's all about the discounted, the risk-weighted adjustment on future cash flows. Hard to do that with an exploration company that just spends money. It's all about discovery. It's hard to put a valuation on an exploration company. When it has a resource, you could try the EV per ounce just to do a metric. But then, was this heap leach, or is this milling with refractory? Is this in Colombia, or is this in the DRC? It's hard.
Not every gram is equal.
Yeah. Not every ounce is equal. So then you get to the point where the important thing is all these companies that we're talking about that are generating free cash flow, want growth, want to keep issuing dividends, maybe looking at a flat production profile to growth, they're looking at like, how do I feed my profile? Where do I get the next asset? And so if you find something, despite the market being negative on gold, your suitor, the buyer of your ultimate equity, who might be your M&A suitor, is less concerned about that. But that's not going to show up in your share price. You could be still trading at a discount and get lots of selling on good news flow, on a really good drill hole. And a lot of people that I talked to were complaining about that. Like, we put out this drill hole, it was fantastic, and the share price went down. And then there's a little bit of concern, like how much working capital do I have? What catalyst can I actually ride on, and will that actually be a catalyst that moves my share price? So those are like you're saying, the issues that juniors are dealing with.
Yeah, but obviously in that that situation, companies are operating within a broader market, and what happens in the broader market is going to have perhaps the overriding impact. Having said that, there are companies who put out results, and a good example just this week would be I80 Gold and the deal it did with Barrick Gold. In a day where the gold price went down, I don't know, $10, $15, $20, their share price went up 10 or 15%.
On 6 to 7 times volume, and that's what you want to see. You want to see high volume. You want to see people interested. But the thing is that if you get a really good drill hole, you do a transaction like I80, people notice. And that wasn't driven by what the gold price was doing that day, which wasn't much, and the GDX and GXJ were both down. But they can see the value add. They say, "Oh, wow, you're going to get, an autoclave. Who else has got autoclaves besides Nevada Gold Mines? Nobody. Jarrett Canyon's got a roaster, but it's in the middle of nowhere, and toll milling would be hard from there. Here you have one right on the highway, and it's permitted.
Yeah.
So, there's nobody else in Nevada or in that part of the U.S. that has one.
So an interesting observation there is Barrick Gold, or let's more specifically Nevada Gold Mines, has gone from being the only game in town in terms of processing, the ability to process refractory ore, to creating a competitor.
But it's not, for me, it's not a huge competitor, but they were not willing to let go that leverage to having all the permitted capacity to deal with refractory ore that's non-carbonaceous in that part of the world. They were very reluctant. But what was happening was the South Arturo joint venture was getting more important in terms of what they were doing in their Gold Strike complex, to the point where they said, okay, we'll do a swap.
We need to run this. Yeah.
We need to run this. We need to run this the way we want to run it. We don't need to keep talking to you.
Yeah.
So to get that, and nobody else in Nevada, wherever, had that kind of leverage to make that kind of transaction. And the Lone Tree was actually an asset from Newmont, not Barrick.
I guess one of the interesting things there is that in the past, up until relatively recently, anybody in Nevada with refractory ore was always potentially trying to condition their project to Barrick and make it attractive to Barrick. Now they've got another door to knock
Well,
on.
here's the thing: is before Nevada Gold Mines, they could play Barrick against Newmont, but now with Nevada Gold Mines, I mean, with Barrick and Newmont being together, they can't play that. And Jarrett Canyon's a non-starter. So then you're never going to look. I mean, I'm not talking just about juniors. I'm talking about mid-tiers. You know, the only, the major mid-tier there, you got mid-tier is SSR Mining, but they're doing open pit heap leach. You know, Equinox is in California, all heap leach. You know, but nobody can do refractory ore.
Coal mining.
Yeah, or Allied Nevada, Highcroft. Now, you know, they want to do a different method, but I listened into their presentation, and one of their options now they're actually thinking about a POX plant.
Yeah.
You know, so people are, you know, infrastructure permits, especially in places like the U.S., are very important, because you can have all the money you want, but to get a permitted, autoclave that could take 3,500 tons per day is not easy.
So, like, face value, that puts I80 in a pretty healthy position for
Hence
the ability to do deal.
Reaction.
Yeah.
That's the market's reaction, because that is unique, and they use their comparative advantage with Nevada Gold Mines to make that transaction. You know, so I think that was a great deal, and people saw it for what it was, and so that's positive for the market. That, you know, even, you know, thankfully the good transaction and the good news still sees a bump.
Yeah, yeah. Well, let's carry on the theme of sort of transactions. You know, people have been talking about, you know, pretty much for the last 2 or 3 years since the Barrick Randgold merger, since Newmont and Goldcorp, there's still the need for consolidation. The intermediate sector of the gold market is still overpopulated. Obviously, there's a lot of juniors lower down the chain as well. You know, the bigger companies, the producers, they're depleting their resources. Transactions are slow coming through. The need for transactions, for M&A activity is there. When's it going to happen? What have you been hearing here?
So if we just talk about precious metals, we have been seeing more M&A in the base metals and the battery metals. But yeah, there has been a little bit of a paucity with M&A on the precious. But what we got to remember is that we've seen some incremental transactions, and I think that right now what we're seeing is that if somebody has a processing facility, the central thematic appears to be that I don't want to run out of ore, and I don't want to hit my reclamation bond. I want to find more ore. So that incremental, where a junior has not a standalone project, but it's near my facility, that's definitely something that's getting taken out.
Somebody phrased it to me as a few years ago that the majors were looking for projects, deposits, 3 to 5 million ounces. Now they're perhaps more focused on a deposit that can add 1 million ounces, bolt on to something they already have, they're about to build.
It's two different thematics. One thematic is the 5 million, 3 to 5 million ounce in a greenfield spot, which can justify a standalone. But a 1 to 2 they might have not have thought of before, until now, when their processing facilities are running out of feed. Now it makes more sense. Now they need the feed, and you know, also like with the I80 transaction, how they actually make that feed and organize that feed, it makes it easier when they own 100% of the asset. Then they have to talk to somebody about it.
Now there's a few regions where that competitive tension, if you like, is building. You know, in Ontario and Quebec, for example.
Well, I'm not sure. Sorry, to interrupt, but I'm not sure if there's much competitive attraction on the bolt-ons, because the bolt-on, you make it attractive to you.
Well, my point was, you know, is the majors looking to pick up property and projects in those areas. But a lot of tire kicking going on, a lot of corporate development teams sniffing out what's there and what deals may be able to be made. But nobody's pulling a trigger yet. Nobody's pulling the trigger. Why do you think the majors are waiting?
Well, I mean, the big companies have had a lot of dilutive M&A, and there's still that history and people still remember some of it. So they're probably less willing to make a major transaction until they've dotted all the I's and crossed all the T's, which is taking longer without being able to do much due diligence on projects unless they have an operating mine there. So there's that. And then the other issue is that, I need, when do I need that feed? If I don't need that feed for 10 years, I'm not pulling the trigger. Because they need to prove it to me, and I could just sit here and wait forever.
So let the junior continue de-risking on their dollar.
And they're asking, oh yeah, that's nice. Show me your data. Why don't you do this? Do some more metallurgy. Drill some holes over there. Do this. And then, they're sort of playing the puppeteer there with the junior.
Well, another aspect I heard along those lines is that, we mentioned that the sort of the bifurcation between, the gold price and the sort of junior equity prices, and some people think that's only going to continue to increase, i.e. the junior equities are only going to continue to get cheaper. We're obviously coming in towards tax loss selling, so why pay for something today when it's likely to be cheaper tomorrow?
Well, especially if you're the only one adding value. If whatever they do, they can never build it because it's not big enough. You say, well, I'm the only one that's going to, because them toll milling it to me is is a non-starter for them, because they're not going to make a lot of money. So because I'm going to be very egregious on the toll milling, because they've got nowhere else to spend it. I mean, take it, and they're not going to raise, let's say, $200 million for a standalone plant, and they don't have the people to build it. So I'll just wait.
Well, I guess that kind of, in some ways, brings the conversation round again, because we're getting back to that sort of valuation we talked about earlier, because that being the case, juniors are obviously burning through their cash, and at a certain point they'll burn through it and will need to raise again, and dilution, valuation. There's many companies here that are getting down to their sort of last 6 months of money. They're going to have to come back to the market at some point. I imagine there's a lot of companies in a very difficult position. They're sort of trying to weigh up what their valuation is today, their share price and market cap is today. Is that going to go up? Is it going to go down? How dilutive will it be for them to get the money to do the next year, 2 years work?
So if we look at dilution, I mean, as investors in equity, we always look at the denominator, which is how many shares. But we also have to think about the numerator, which is the asset. And so there's two ways of diluting yourself. There's one, issue more shares, or selling part of the asset. And that could be a joint venture, that could be a royalty, that could be a stream, that could be something like that. And so when you're trading at what you think is a big discount to what you think you're worth, you may be reluctant to issue shares when you could sell a 1% royalty where you don't have any royalties on the asset, at a big premium. Because and then that will take you over a year or two, and then get you some catalysts that'll bring your share price up such that you could issue equity then.
Isn't that a very risky strategy? Because one thing you hear from the majors, they hate royalties because it takes away their potential upside,
and that was the
attracting
interview that we did with Rob. But when you talk to the major, that is always coming from their perspective. Don't do that.
Of course, yeah.
But from the junior, well, you give me money at a 40 or 50% premium. No, they're not going to do it. Okay, this is my only option. So unless you're willing to step in, don't ask them, to do something that the market's not saying that they can do.
Well, one understands the phobia about dilution, because obviously a lot of management teams are heavily invested in the companies as well, so it impacts them personally in addition to professionally. But can that get into the situation where management isn't necessarily making effective decisions because they're more worried about their own personal wealth than sourcing the funds to guarantee the future work programs of a company?
Okay, like any CEO, and CEO is nothing I ever want to be in, because they have to deal, like the difference is when you're dealing with equity and you're dealing with share price and the share price value, that's almost one stakeholder you're concerned about, are the people that own your shares. When you become a CEO, you have to not only work with the shareholders, you might have debt holders, you might have a streaming firm, you've got the people at site, you've got your own employees, you can have a lot of stakeholders, and you have to manage all those concerns. Can you keep these people employed? Where are you going to look for more assets and all that? And you got to play that game, and then then you have to fund that plan. And then the question is, how do I fund that plan? And every CEO is going to think about it. Funding it just through equity or not funding it through equity. People would say, well, don't do a stream, versus issuing equity. When we go back to Rio 2, when they're to build their project in Chile, they didn't think that their share price was at a point where they could raise the kind of money that they could with a stream, and so they went with the stream. They thought that was a lower cost of capital than raising equity. A stream is easily 15% cost of capital, so they're thinking that diluting at that point was going to be a higher cost, and that's what you got to do.
I guess there's no sort of cut and dried answer to that.
And never is. And so when you look at how somebody, funds themselves, take the critical point of view is what were their options, and some people may not have had many options.
But did you see that some CEOs defer that decision to such an extent that they end up putting their company into a financial hardship, into a position where anybody that's likely to do an equity financing knows they're up against the ropes and really hammers them because they didn't raise early enough?
Well, I would say that if you've got a development project and the price isn't right with respect to you building it, hold it. Because if the price isn't going, if your valuation isn't going high enough, and you're not going into that market, you're building into that, it's going to be harder to fund it. And when you come out, you might not generate as much free cash flow, so it might be better just to burn the minimum and wait.
Okay, let's follow the thread of development stage projects now, because I've spoken to a few developers, and one of the things that's starting to come in is inflation of inputs, steel prices, fuel prices, cement prices, lead times and long lead items are getting longer, so the potential for, I won't say capex blowouts, but capex is increasing beyond what was in the feasibility or whatever the economic study was that they're basing the decision on.
I wouldn't say right now that there's like a plethora of development projects that are all coming online, but in specific spots, there's just not enough people, and that lack of human resource has been a theme that's been going for more than a decade in the resource sector, and it's hitting potentially harder now. And now, if you have a region like, let's say, Ontario, your Cote Lake's going to be built, Magino's going to be built, and Equinox is talking about building Hard Rock. So it's three major projects that are going to be built around the same time. And then you think, well, where are they going to get all those people? And the inflation that's going to be related to all that. And so we could see, and we always do see, 30% capex blowouts. A junior doesn't have the capacity usually to deal with that unless they really want to build it and understand the idea of working capital.
Yeah.
And we saw that with what's that company? Was it USA Gold and Silver?
America's Gold and Silver.
Yeah, at Relief Canyon. So they were heap leaching. They put too much carbonaceous material on the heap leach. Didn't get the recoveries. Ran out of money. They had to shut it down. And that can happen. But if you don't have the working capital, it's hard to inject more capital and make it right.
Well, yeah, I mean, that's always going to be an issue for the single asset developer. Nevada Copper's had similar issues. Victoria Gold has had issues. Even Pure Gold Mining had
they
issues.
Just raised money.
Yeah, they just did a $20 million deal.
Bought deal. Yeah. So
it's not easy.
It's not easy. Yes, it's not easy, people.
That could be a good point to stop. I think it's not easy.
All right. Well, thanks, Paul.
Thank you, Joe. Pleasure seeing you again, and great discussion. A lot of information, a lot of people here. Yeah. It's good to sort of get closer to the beast once again.
That's right. All right. Thank you for joining us. So hopefully this was helpful.
Yeah, that's all for us today on Joe and Paul's Mining Podcast. Join us again soon for the next one. Thank you.
Cheers.